Good day, fellow investors. The new JPM Guide to Markets is out. We did yesterday the US, and now let's do Europe with the focus on investing from Europe. As I've been getting a lot of questions, Sven, what should we do with our currency? How to deal from Europe from an investing perspective? But also, if you're from outside Europe, it is a great view of what happens, what's going on, and what are the risks. And yes, Europe is unfortunately one of the weakest links out there, and we have to be mindful of that when it comes to investing. Let's start with the economic situation, discuss interest rates, what the ECB can or can't do, the outlook, and of course, investing with currencies. That's the issues we have now as investors from Europe. If we look at the economy, now consumption saved GDP over the last quarters, especially as the governments injected a lot of money. Now there is pent-up demand, and end September I went to my home in Croatia, and this was the line, the crazy insanity of how many Germans went to the seaside and September. So really there was a lot of money, a lot of spending of that government money, because this was endless for September. It is crazy, and therefore it is very likely that next year it won't be like this and that Europe will go in a recession. And if we look at the economic monitor, only manufacturing was negative for the US, but if you look at Europe, everything except the labor market is negative. And that is because they take the average. If you take España or something like that, that's also negative. Thus, there is extremely high recession risks in Europe, plus with the energy crisis and the incapacity of the ECB to print money, we are looking for a stagflation situation, which is very, very ugly. Consumer confidence has been going down, and that is also because people see that they are spending the money that they received from the governments for staying at home, and that also the governments have an issue with those debts and everything, as they have to hike prices. And yes, electricity prices have boomed. That is also an issue that impacts spending, but I think that's just one factor in the big picture. Another thing that few discuss, average unemployment in Europe, okay, we have it, but if you compare Deutschland, there things look great, and Spain, there things look terrible. This is 12% unemployment. Italy, France, 7-8%. Of these 12%, 50% of these are young people between 25 and 40, and es un completo disastro, because that is a destruction of long-term human capital. If you don't work from your 20s to your 30s, you don't learn, you don't get experience, and it simply means that you will be less productive over your lifetime. And therefore, that's a huge issue that will be a big impact in the long term if it already isn't there. From language, from English, from competing in the global marketplace, that's a huge issue. And yes, everyone is printing money, so nobody cares. But again, people should address what really matters and not try to kick the can down the road by printing more money. Nevertheless, inflation has exploded. This is what matters. You cannot take out energy and then say, oh, it's lower because this is what you pay. Thus, this is what matters. And you can see that everything is going up. It is all connected. Something lags, something doesn't. And inflation is there likely to stay, especially in euros. And when you look at the economy, the Europe economy, this is the line, and you can see that it has declined at the fastest rate compared to the US that just started losing global economy share. Also, Japan went even up and then started, but Europe has been declining its presence, its power over the last 50 years, surely and steadily. So this shows really the fundamentals of what's going on in the Eurozone, and that will be reflected in the currency power, in the spending, in our lives as those are. There is no way to avoid it. Now, everything is tried with interest rates, money printing. Let's discuss that, but that has also its limits. So if we look at the ECB, the rates are here and they expect it to stop at 2 point something percent. Keep in mind the Fed expects to stop at 4.5%. That's this. Why there is such a difference? Because simply Europe doesn't have the fundamentals to push rates higher. In these good economic times, they kept rates negative to stimulate inflation, and that now shows, okay, we have kicked the can down the road, but we'll see how it goes further. Look at the money the ECB has printed over the last decade. It's staggering, and now we have already Italy, Greece issues and everything because of the high interest rates. Those will have to be bailed out. Credit Suisse, Deutsche, whatever, low-hanging fruit for bailouts and issues. And as soon as interest rates start going up, there will be a lot of issues in Europe. And that is why I think that when you compare the US and Europe, Europe is the weakest link. And there are issues everywhere, but Europe seems like the weakest links from a political perspective. When trouble hits Europe, there will be disintegration because everyone will try to get their short-term benefit, and you can throw the euro out with the trash. That's a big issue. The key issue is the fundamentals, the demographics, the productivity, and everything. The ECB tried to do whatever they can, and everyone wants free money, but the return on that free money hasn't been high. The productivity levels aren't high. Those are going down, unemployment and everything. And that leads to everything that has come out now with inflation, with the euro going down compared to other currencies, and that's something we will simply have to live with. There is no other. And when it comes to investing, people think now it's too expensive to invest elsewhere because of the weak euro, but I'm thinking the euro can also be weaker, go weaker. Fundamentally, it will be the weakest link in the global currency situation. So from that perspective, you might want to buy things that will do good no matter what, and even cover for that potential currency loss that you will have if the euro strengthens. Of course, if the ECB pushes rates higher, then the euro might strengthen for a while. The currencies will always be volatile, so that might be something, but that is something I am not betting my portfolio on or my money on, that the euro will get stronger. That is too risky of a bet to take looking at the fundamentals. Because if they push rates higher and then they see we can't push rates higher, we have to print to save Italy, Greece and whatever, then simply the euro will be lost as a currency, and it's very likely it will be the first one to get lost. If we look at earnings, so everyone is still projecting high earnings, but look at the past in Europe. These earnings are very volatile and often crash significantly. We have had money printing, which allowed for higher earnings, but if we go back to normality, then even the valuations will go down. And look at how earnings went down for 5-6 years in the early 2010s on macroeconomic issues. That is a big issue, and no matter that the forward earnings expected, Wall Street bullish bias earnings, are just 10, which is saying, okay, Europe is cheap. But then again, if you look at what is cheap, energy, that might revert. Financials, the biggest companies there are cheap. Materials on last year's earnings are cheap. Everything else is not that cheap. And many say, Sven, go look at small caps. Yes, Sven, go look at small caps. But small caps have boomed already in the last years, and now those are reverting. Okay, these are banks and all the legacy old businesses. I might get interested as we are going down, but I am in no rush because of the fundamentals. And yes, valuations are going down. There might be diamonds in the rough, so that's also something we will likely do over the winter, research more and more Europe, US, and then of course with the commodities see where we get out. IT businesses and everything are a little bit high, utilities are also high but good dividend yields, however the high debt makes them risky, and all of these earnings valuations will likely go up as the earnings revert. And then when it comes to investing also, Eduardo had the great question, is really everything that cheap? The S&P is down 20 something, but the euro also lost the same amount to the dollar. Or you ignore the currency behavior in the short term, counting that in the long term it should get back to normal. I don't know what normal is. Maybe it will get back, maybe it won't. Maybe the normal is another 20% down. So it's very hard to predict these currencies, and I always say better to be invested in businesses rather than currencies. And Stein here says a very interesting note here that people outside the US have to be long the dollar now, keep cash, wait for a Fed pivot, then slowly get into US stocks, ride the wave up, then get back into euro when the EU starts recuperating. Now, this all sounds great, but I have a feeling that this is based on the information we have up till now, that the Fed will pivot, that US stocks will go up, that the dollar will keep its strength, and then you have step 1, step 2, step 3. I hope for Stein it works like that, but what if everything is the opposite? So we have to be short the dollar now as the euro might strengthen. We have to be invested now as stocks might go up, as currencies decline. The Fed might pivot later to get rid of inflation. Stocks in the US might then have peaked already. And then EU stocks are the cheap ones and not US. So it's very hard that we predict what's going on here. And then if the ECB hikes more than the Fed, we might see a reversal also in the currency and everything. My main point is always look at the fundamentals, no matter the currencies. We'll go next week likely more into European stocks. We did 10 US, we'll go 10 European, and then we'll likely give these quick takes, and who knows, maybe we'll find some interesting for our YouTube portfolio. You can check the last update here of the YouTube portfolio, and I'm sure you might find some interesting ideas for your portfolio. Thanks for watching, and I'll see you in the next video.